How to leverage algorithmic trading in options. In the fast-paced world of financial markets, options trading stands out for its potential to generate significant returns. However, this potential is accompanied by a unique set of risks and complexities that can be daunting for both novice and seasoned traders. The challenge is clear. How can traders harness the power of algorithmic trading to optimize their options trading strategies while managing inherent risks effectively? This video aims to provide a comprehensive guide to leveraging algorithmic trading in options. By understanding options dynamics, integrating volatility models, and managing risk carefully, traders can develop robust strategies that enhance their trading outcomes. We will delve into each of these aspects with practical examples, offering actionable insights to help you navigate the intricate landscape of options trading. Point 1. Understand options dynamics. Options trading differs significantly from other financial instruments, primarily due to its unique features such as time decay, strike prices, and the concept of intrinsic and extrinsic value. A solid grasp of these dynamics is essential for developing effective algorithmic trading strategies. Example 1. Time decay. One of the unique features of options is time decay, which refers to the reduction in the value of an option as it approaches its expiration date. This phenomenon, also known as theta decay, means that options lose value as time progresses, all else being equal. Traders must account for this when developing their algorithms. For instance, a trader using an algorithm might prioritize strategies that exploit short-term movements in the underlying asset, minimizing the impact of time decay. Consider a scenario where an algorithm is designed to trade weekly options. The algorithm could be programmed to enter and exit trades within a few days, capitalizing on short-term price movements and avoiding the significant time decay that occurs as the expiration date approaches. By doing so, the algorithm reduces the risk associated with holding options contracts that are rapidly losing value. Example 2. Strike prices and intrinsic value. Strike price selection is crucial in options trading. The intrinsic value of an option depends on the relationship between the strike price and the current price of the underlying asset. An option is said to be in the money if it has intrinsic value, meaning the underlying asset's price is favorable relative to the option's strike price. Conversely, an option is out of the money if it has no intrinsic value. Algorithms can be designed to scan multiple strike prices and determine the most favorable ones for buying or selling options, optimizing the potential for profitable trades. For example, an algorithm might evaluate the delta of various strike prices. Delta measures the sensitivity of an option's price to changes in the price of the underlying asset. By selecting options with higher deltas, the algorithm can identify opportunities where the option price is more responsive to movements in the underlying asset, thereby increasing the potential for profit. Point 2. Integrate volatility models. Volatility plays a critical role in options pricing. Incorporating volatility forecasting into your trading algorithms can enhance the accuracy of pricing models and improve trading decisions. Volatility reflects the degree of variation in the price of the underlying asset and can significantly impact the value of options contracts. Example 1. Implied volatility. Implied volatility is a measure of market expectations for future volatility and is a key input in options pricing models. It reflects the market's view of the likelihood of changes in the underlying asset's price. By integrating implied volatility forecasts into your algorithms, you can adjust your strategies based on anticipated market movements. For instance, during periods of high implied volatility, algorithms might focus on strategies that benefit from large price swings. A trader could use an algorithm to implement a straddle strategy, which involves buying both a call and a put option at the same strike price and expiration date. This strategy profits from significant price movements in either direction. By monitoring implied volatility, the algorithm can optimize the timing of entering and exiting these positions to maximize returns. Example 2. Historical volatility. Historical volatility, which measures the volatility of the underlying asset based on past price movements, can also be a valuable input for trading algorithms. Historical volatility provides insights into the asset's past behavior, allowing traders to identify patterns and predict future price movements. An algorithm might use historical volatility data to identify periods of low volatility that are likely to be followed by high volatility. For example, an algorithm could implement an iron condor strategy, which involves selling a call and a put at different strike prices, while simultaneously buying a call and a put at further out of the money strike prices. This strategy profits from low volatility, as the options expire worthless. By analyzing historical volatility, the algorithm can identify optimal times to implement this strategy, enhancing the potential for profit. Point 3. Manage risk carefully. While options trading can amplify gains, it can also magnify losses. Implementing robust risk management strategies is crucial to protecting your portfolio and ensuring long-term success. Effective risk management involves not only controlling potential losses but also optimizing the risk-reward ratio of your trades. Example 1. Position sizing. Proper position sizing is a fundamental aspect of risk management. Determining the optimal size of each position based on factors such as account size, risk tolerance, and market conditions can significantly impact your overall trading performance. Algorithms can be programmed to calculate position sizes that align with your risk management rules. For instance, a trader might use a fixed percentage of their account balance for each trade. During volatile market periods, the algorithm might reduce position sizes to mitigate potential losses, while during stable periods, it might increase position sizes to capitalize on favorable market conditions. Example 2. Stop-loss orders. Stop-loss orders are an effective tool for limiting losses in options trading. An algorithm can automatically place stop-loss orders at predefined levels to exit positions when the market moves against them. This helps to cap losses and protect the trader's capital. Consider a scenario where an algorithm is designed to trade call options on a particular stock. The algorithm could be programmed to set a stop-loss order at a specific percentage below the purchase price of the call option. If the stock price declines and the option's value drops to the stop-loss level, the algorithm automatically sells the option, preventing further losses. This automated approach ensures that losses are controlled without the need for constant monitoring. Conclusion. Leveraging algorithmic trading in options requires a thorough understanding of options dynamics, the integration of volatility models, and meticulous risk management. By following these principles and incorporating the examples provided, traders can enhance their strategies and navigate the complexities of options trading more effectively. Whether you are new to options trading or looking to refine your existing strategies, these insights will equip you with the tools needed to succeed in the dynamic world of options trading. Happy trading!